Yeah.
Hi, everyone.
How you doing?
Hello, thank you. Thank you, everyone, for joining ABGF's Growth Capital webinar. I think we've got a lot of people who are joining at the moment. I think that there's maybe a bit of background noise, and hopefully we'll manage that and turn that off. But it's wonderful to see so many people registering for our webinar and joining today. But I think while we're waiting for people to trickle in over the next couple of minutes, I might just give a quick recap of why we're all here today. So for context, we're the Australian Business Growth Fund, or ABGF, and we'll tell you more about who we are shortly. And we're running this webinar for anyone in the community, so that includes business owners, advisors, other investors, to learn more about what we do and how we invest, and more about growth capital more generally. So just a few introductory slides to get us started while people are still joining the webinar. I'll just talk you through the four members of our team who are going to be speaking today. So firstly, we have Anthony Healy, ABGF's founding CEO and Managing Director. So Anthony previously worked at NAB as Chief Customer Officer prior to leaving banking to found ABGF. And before NAB, he held a number of roles across the banking sector, including as CEO of the Bank of New Zealand and Head of Business Banking at ANZ. And we also have Patrick Verlaine. He's one of our two co-heads of investments at the fund. And prior to joining ABGF, he was a partner at mid-market private equity fund Crescent Capital. You'll also be hearing a bit more from me. I'm Lucinda Bradshaw, an investment director at the fund. Previously, I worked at a mid-market private equity fund called BBRC. And then you've also got our origination director, Tim Hayden, who's joined us from Barclays, where he worked in leveraged finance. So that's the team that you'll be hearing from today. I'll just give you a quick overview of the agenda for today's webinar. So we've got a good amount of time. We're going to start off by talking to you about ABGF and giving you an introduction to our fund. We'll then talk more generally about growth capital, including how it's different from venture capital or private equity, traditional buyout private equity. And then we'll talk a bit about what it means to partner with or receive investment from ABGF, including what our investment process looks like and how we value a business when investing. We'll also talk about how we can give shareholders liquidity to help them de-risk. And then finally, we'll share a case study of one of the businesses that we've invested in before moving into some Q&A. So just a bit of housekeeping before we get stuck into the proper section of the webinar. But there will be about 10 minutes for Q&A at the end of today's session. So please just keep in mind that we won't be answering any questions during the presentation, but there will be time at the end. If you do have any questions, though, as we go through our slides, please feel free to drop your questions in the Q&A function, the chat function on Teams, and we'll try and get to them at the end of the session. And when we move into Q&A, you can also feel free to use the raise hand function as well, and you can ask a question live then. So I think without further ado then, hopefully we've got a critical mass to get started, and I'll hand over to Anthony to talk more about the fund.
All right, thank you, Lucinda, and welcome to everyone that's on the call. And I can see we've still got a bunch coming through, so we'll keep going. So as Lucinda pointed out, the ABGF Australian Business Growth Fund is Australia's only purpose-built growth capital fund dedicated to supporting small and medium enterprises. We were established in 2020, late 2020, and you can see at the bottom who our shareholders are: the major banks, Macquarie, HSBC, and the federal government. So it's a pretty unique public-private partnership, and I think it was in recognition of the fact that there has been, a lack of really deep liquidity in this space for growth capital for SMEs. So we raised 540 million of capital from our 7 shareholders, and we invest patient minority growth capital into founder-led businesses. Whilst we have the banks and the government as shareholders, all of our investment decisions are independent of our shareholders. I chair the investment committee and the investment team, the other members of the investment committee. So we make our decisions independently from our shareholders. And our objective is to bring this much needed growth capital to the SME sector to support founders to achieve their growth aspirations. We obviously have some really deep commitment to the purpose of the fund around driving economic growth and creating jobs and supporting Australia's innovative and entrepreneurial ecosystem. So thanks, Lucinda. If we can go to the next slide. So just so everyone understands where we fit in and what our mandate is, we sit between venture capital and larger buyout funds. We look for businesses that have a track record of profitability, turning over between typically 10 and 100 million. Our initial check size we write for investment is between 5 and 15 million to take a minority stake. And we can do follow-on of another 5 to 15 million as many businesses need follow-on for more growth. As a minority shareholder, we obviously can't force exit, so we typically look for somewhere between a 3 and 10-year investment horizon. So it really is patient growth capital. And in this space, there are very few funds or investors that are really taking minority stakes in businesses of this size, hence why we set up the fund in the first place. So I'm going to hand now, I think, to Tim, who's going to take you through the next couple of slides.
Thanks, Anthony. We thought we'd just give a quick sense of the target profile of investments that we look at. So first thing to call out is we look for high growth businesses and we're sector agnostic in our approach. So what I mean by that is we look at a range of different sectors with a few specific carve-outs, which I'll talk to, which is shown at the bottom of the page. But typical characteristics of investments that we look at is Australian headquartered businesses, businesses with up to 100 million of revenue and a track record of profitability. We also look for businesses with a unique value proposition. And what we mean by unique value proposition is not necessarily that a business needs to have a one-of-a-kind product or service, but it's really about a business that's delivering exceptional value for their customer base and clients. The typical characteristics of what we see as a unique value proposition in a business is really having strong management teams, a proven market position, and a loyal customer base and robust internal operations. And it's these types of things that we see give them a competitive edge versus their competitors. The other thing we look for is significant growth potential in businesses. And this really refers to the capacity of a business to significantly expand its operations, revenues, and its market presence. And there's a number of ways that businesses can achieve this, either by entering new markets, expanding their market share within their existing markets they operate in, introducing new products or services, or M&A in order to achieve that growth. The other thing which we look for is we look for founders that are keen for partnerships and not just the capital invested in the business. And we'll talk to this a little bit in one of our case studies to give you a live example of how we do partner with and assist companies in their growth trajectory. So a couple of call outs in terms of sectors that we don't invest in. So startups and unproven business models are not businesses that we look at. Controlling equity stakes, as Anthony mentioned earlier, we are a minority-only investor. Change of control buyouts, where the existing majority shareholder group is being completely removed. Distressed investments, natural resources extraction, and also APRA-regulated businesses that are in competition with our shareholders. Also worth calling out real estate. So situations that we invest in, we look at a range of different situations where there's a capital requirement in a business. The first one to mention is strategic growth support. So this can be a capital injection into the business, whether it's to fund an acquisition, expansion in the business, working capital or production capacity, and also the capabilities and support that we can offer as a fund to support you in that growth trajectory. Another typical situation that comes up is succession. So we have a strong and established approach to governance of SME businesses, which again we'll talk to a bit more in a case study in terms of how we operate as an investor. But a lot of companies see us as a really important step in potentially thinking through a succession dynamic that they have in play with their business. The other area is M&A. So if you're looking at acquiring a business within your industry, our capital can be a great source of funds for that. And the final one to note is money off the table. So this is really about in certain situations where we can offer secondary funding to an owner of a business in order to de-risk a portion of their investment in the business. So let's see if we could move to the next slide. And here we're just summarizing our investment approach. And as Anthony mentioned, so we're a minority-only investor. And what this means is that as an investor, we will leave the existing shareholder group in control of the business. We can invest up to $15 million with a minimum check size of $5 million. And then also have the ability to fund a further $15 million for the same asset. We take an active approach in our investment, and what this means is we look to provide hands-on support and really support companies in their growth trajectory, both from a board level and from an operational perspective where a business needs the support. And then also worth calling out, given our shareholder base and our approach to investing, we have the ability to invest in a more patient manner than some of our peers. So I think I might.
Yeah, so now I'll spend a little bit of time talking about valuation and how we think about valuing a business. And essentially, when it comes to valuing a business, we look at enterprise value, which we calculate by multiplying the EBITDA or earnings of a business by an EBITDA multiple or an earnings multiple. I'll talk a little bit more about that formula on the next slide, but I might just spend a bit of time now talking about the EBITDA multiple that we use when valuing a business, because it is a really significant driver of valuation. And there are a couple of things that we look at when determining an EBITDA multiple. I think probably the critical place where we start is by looking at the market that a business operates in and its broader industry. So when we're looking at a market, we're thinking about things like how big is that market? Is it a very large market where it'll be easier to take market share, for example? Is it a market that is growing quite quickly? So there are broader growth drivers for the business rather than a market that's just simply growing at CPI or kind of population growth, where it'll be a lot harder for a business to grow. We also think about broader trends in the market, and then also things like competitive dynamics. What are the barriers to entry for different businesses playing in that market? Is it very concentrated with a couple of really large players, or more of a cottage industry where it's possible to aggregate and grow? And then we'll also think about the business profile itself. So the specific characteristics, financial and otherwise, of the business we're looking at investing in. And that includes things like profitability, both the size of its profits, so how much is it earning or able to earn, and then also what does that look like on a margin basis? Is this a high gross margin or EBITDA margin business, or a relatively low gross margin or EBITDA margin business? We'll also think about the quality of a business's earnings. So that's looking at really how repeatable are its earnings year after year, and are they backed by things like long-term contracts, recurring revenue? And then we'll also think about capital intensity. So how much CapEx does a business require in order to scale, essentially? How much of its cash flow is it required to invest into CapEx year after year? More broadly on the commercial side, we'll also think about a business's suppliers and customers. So how diversified or concentrated are they? And then also the quality of its management team. So what's their experience, and are there any gaps in the management team that we would need to fill in order to invest? And then stepping back, we'll also have a look at broader risks. So things like regulatory changes, if it's a business that's heavily regulated, and macroeconomic trends as well. So putting all of those things together, what that really means is that businesses in different industries really trade at quite different EBITDA multiples. And you can see in the chart on the right-hand side of the page, for example, software businesses typically trade at quite high EBITDA multiples in the teens. And that's because these kinds of businesses, they typically operate in a very large market that is growing very quickly. Obviously, there's very strong growth drivers for software businesses. They also typically have very high margins, so that they're generally very high gross margin businesses, often with pretty good quality of earnings because revenue may be recurring. So that means that these businesses typically trade for higher multiples compared to, for example, industrial businesses, which you can see lower down in the chart, generally trade in a kind of low to medium to high single-digit multiple. And that's because industrials businesses or kind of manufacturing type businesses typically have much lower margins, typically are much more capital intensive, and often operate in businesses or in industries that are a bit more niche with a smaller total market size. So these are the kinds of things that we think about when coming up with an EBITDA multiple. Now, putting all of that together in terms of actually how we come up with an enterprise value, we've got an example here of a manufacturing business. And I'll just take you through the formula that we think through when we calculate that enterprise value. So starting with earnings. So the example that I used previously, or I was describing previously, valuation using an EBITDA multiple, but there are some situations where we would look at using a different earnings metric, for example, EBIT. And that's often in businesses that are much more capital intensive. We want to look at earnings before interest and tax, but after depreciation and amortization because of the high level of capex that may be required in those kinds of businesses. And a manufacturing business is often a business where we would look at EBIT instead of EBITDA. However, in this specific example, we ended up using an EBITDA multiple because of the very long life cycle of the equipment being used by this business, which meant that their maintenance capex was actually very low. So we were comfortable valuing them off EBITDA. So the next thing we look at when looking at an earnings number is the time period that we use to determine those earnings. And often we'll look at a historic EBITDA or earnings figure, so perhaps the last 12 months of earnings or potentially the last financial year. But in this situation, and we're going back in time now, but we were comfortable to use a forward, so a forecast FY24 EBITDA figure, because in this specific situation, we had 9 months of actual financial results plus a 3-month forecast. And that 3-month forecast in this scenario was backed by contracts. So we had very high certainty of the earnings that were going to come through in the final 3 months of the year. So that would be a kind of scenario where we would be comfortable potentially using a forecast EBITDA figure. And then lastly, the thing that we look at is whether that EBITDA figure is a reported, basically a pure EBITDA number, or whether it's adjusted for any one-off items. And in this situation, we used a pro forma or adjusted EBITDA figure, which was adjusted to reflect the fact that certain sales had been lost due to one-off items or issues in the business. So we'll typically look and see what in the EBITDA number that we're using is recurring or non-recurring, and non-recurring items or one-off issues we can adjust for when coming up with the earnings figure. So that's earnings. Then when it comes to working out the earnings multiple, I talked about all the factors that go into basically determining that earnings multiple. But in terms of how we figure that out, we do quite a lot of research behind the scenes in the early stage of putting together a valuation, researching trading comparables and transaction comparables. And when I talk about trading comparables or comps, I'm talking about basically ASX or foreign listed businesses that operate in similar sectors and have similar characteristics. So we'll have a look at what those businesses are trading for in the market. And then we'll also have a look at transaction comps, so recently traded public or private businesses, which we divide generally into larger and smaller transactions. And typically at ABGF, we'll focus on smaller transactions because those are businesses that are more like the kinds of businesses that we're investing in terms of size. So in this specific example, once we went through that exercise of determining basically where the market was trading at for similar businesses, we identified a range between 5 times on the low end and 10 times on the high end, which is quite a broad range for an earnings multiple. So obviously we need to narrow down that range. And what we'll typically do when we have a fairly broad range is we start drilling down into the specific characteristics, both of the comp set and also of the business itself. So coming back to a lot of those factors I mentioned on the previous slide. So things like profitability, how does the business we're investing in compare to the businesses in our comp set, growth rate, is it growing faster or slower, size, and various other factors. So that's our valuation process. in a nutshell. But just to change topic slightly, I'll just give you an overview now of our investment process as a whole. And I think the key point to make here is that, as Anthony explained earlier on, ABGF really has been designed as a purpose-built investor for SME businesses. And we have really designed our investment process with that firmly in mind, and to try and make our process as disciplined, as easy and as straightforward as possible. And certainly, I think, a lot faster and simpler than other comparable private capital investors in the market. And that's because we really understand how much of a distraction it is to a small and growing business to have to spend time sharing information with investors and collating information for us. So we've come up with an investment process that we can and have completed within 10 weeks from the initial meeting that we have with the management team. And so what that process basically looks like is that within the first month, we'll be working towards our first key gating item, which is our first investment committee meeting. And we have 2 of these investment committee meetings throughout our investment process, and they're basically designed for us to get the approval to move to the next stage of the process. So the first month is really concentrating on getting to that first investment committee meeting. And during that first 4 weeks or so, we're basically spending a lot of time with the management team, getting to know the business, getting to know the industry, and starting some internal financial and commercial due diligence, which we do in-house, trying to get some initial financial information about the business and its growth drivers and the broader industry. So once we have all of that information and we get our first investment committee approval to proceed, we'll then present a term sheet to the management team. And once that's agreed, we then move into our second stage of due diligence, which runs from roughly weeks 5 to 8, where we do our final stage of due diligence. And that involves bringing in external advisors to conduct confirmatory due diligence on financial, tax, and legal issues. And we try and keep this process as quick and efficient as we can. We also round out our commercial DD, which we do in-house, so our team does that ourselves. We'll do site visits if we haven't done that already as part of the first phase, and we'll also do interviews with customers and partners as required. And once that due diligence process is complete, then we can proceed to our final investment committee approval. And once that's received, then we're able to essentially enter legal documentation. Hopefully, we've been negotiating the legal documentation for the last couple of weeks, and that can be agreed fairly efficiently. And then we can proceed to funding. So that's the process end to end. And I'll hand over now to Patrick.
Thanks, Lucy. So I'm just going to cover a couple of liquidity options, or basically ways of monetizing your equity in your business or in your client's business. So the first one is really a change of control transaction. So it's a full sell down, which is what's on the slide here in front of you. So hypothetically, we just assumed it's a business generating $7 million of EBITDA. And we've put a 5 times earnings multiple on that. So to Lucy's earlier point, at 7 times 5 results in an enterprise value of 35 million. Hypothetically, let's say there's $5 million of net debt, so you subtract that from the enterprise value to get to the equity value of 30 million. So if you were to sell a business today, you'd get 30 million in cash off the table and you walk away. So that's great, obviously, because you're maximizing the immediate liquidity. And obviously you can pursue other life goals in the meantime. The downside of that is, of course, you're giving up future potential gains, and you're also unlikely to maximize the short-term value. And if I just turn to the next slide, please, Lucy. This is what we refer to a partial sell down. So again, on the left-hand side, we're starting with the same enterprise value of 35 million. But instead of selling out the entirety of the equity, 100% of your shareholding on the exit date, you decide to take a minority investor such as ourselves on board. And let's say you de-risk and you sell a third of the business, so a third of the equity. So it's about $10 million in cash that you take off the table. And those are shares that ABGF would acquire. So you're left with $20 million in the business at that point in time. Let's assume you then hold on to that business for 5 years and the earnings double over that period of time. So go from $7 million EBITDA to $14 million EBITDA. Now, one of the variables that Lucy highlighted earlier on multiples is scale. Basically, a larger business attracts a higher multiple. So in this scenario, we assume that the multiple goes from 5 to about 6 times. So essentially you've gone from a $35 million enterprise value to an $84 million enterprise value over that 5-year period. If we assume that net debt stays the same for simplicity, you're then going to take off the net debt off the enterprise value to result in a 79 million equity value. So again, so you started off at a 30 million equity value, you've grown that to 79 times, about 2.6 times. If you then sell out at that point, it means you've taken out the $10 million of cash at the first transaction, plus $53 million of cash on the second part of the transaction. So in total, you're taking $63 million off the table rather than $30 million, which was in the full sell down option. So this is what we mean by actually maximizing long-term value. So in the partial sell down scenario, it's great if you want to facilitate succession planning, for example, where you know you've got more potential left in the business to grow, but you're not quite sure how to execute it. Maybe you don't want to take more risk because you've got all your eggs financially in that one basket. So really, this gives you the option to take some money off the table, bring on a sophisticated investor that's going to help you with your strategy, that's going to help you with the capital structure, that's going to help you with execution on recruiting the right talents to build your business, to grow it further, and to actually generate more value on the second exit that you would have got even if you sold the entire business up front. So that's really the benefits, one of the benefits, I guess, of taking on minority equity such as ourselves to be able to maximize value. Obviously, the downside is it takes longer, so you've got to commit to a longer time frame, but you still remain in control of your business for that period of time, given we're a minority only. You can also step back. It facilitates, as I said, the succession planning, because a lot of businesses, small businesses in particular, are really dependent and reliant on their founders, and you might struggle, A, to sell the business at all, or B, to extricate yourself from the business in a sell process. One of the options with us, you can take our money, and actually we can help facilitate that succession through our ownership period, right? So you can essentially transition from an executive role into a non-executive role, at which point it will be much easier to sell the entirety of the business without being reliant on yourself. Thanks, Lucy. I can move to the next slide. So just moving on a little bit, I thought it'd be worthwhile just taking you through, I guess, the variety of industries that we are willing to invest in. To mention up front, we are industry agnostic. We'll invest in most industries, and I think our portfolio today really highlights that diversity that we bring. So just talking through a few examples here. If you start at the top left, our first investment was actually 3ME. It's an off-highway electrification business, so essentially electrifying heavy vehicles in the mining and defense industry. Just to the right of that, CLS is a commercial laundry services business operating in regional Queensland. Capsify, that's a software as a service business. Derwent Industries, it's a heavy industrial manufacturing business, which I'll cover in more detail shortly. You've got DIY, which is an e-commerce retailer. HMC is aviation business. We've got a cosmetics, skincare business. We've got a carpet manufacturing technology business, some protective apparels, specialist healthcare. So you can see how diverse, I guess, the portfolio is. And again, we're certainly open to look at pretty much any sector. So I thought I'd go into a little bit more detail and cover a bit of a case study on one of our investments, which is called Derwent Industries. We think this is a good example because Derwent was a family-owned business, a multi-generational business that was relatively small when we invested. It was largely a supplier of metal fittings to the water industry, and had one foundry operating in Hobart. It recently acquired a second foundry in regional Victoria that was largely selling to the mining industry. So they approached us looking for some growth equity because they wanted to introduce a lot more automation into their facilities, largely competing with China, which was now possible due to the reduction costs of robotics and obviously all the supply chain disruptions that occurred during COVID. So we completed our due diligence, and why did we invest in Derwent? We really liked the management team. We liked their philosophy, their deep industry experience. We liked the growth strategy they had. We obviously agreed with their view that there was a lot of scope for bringing back manufacturing onshore into Australia and creating some sovereign capability, and buying into the growth strategy. So that's what we did. Shortly after our investment, we facilitated 3 acquisitions for the business. One was expanding from metal manufacturing into rubber, so a whole separate facility down in Melbourne. That again opened a whole new sector, I guess, segment of vertical industries that we didn't have access to before, which was defense and automotive. So really diversifying the customer base and the industries that the business was selling to. Obviously, that also significantly increased the workforce. We completed another couple of acquisitions in the meantime, which were really bringing on adjacent products to the existing industries they were servicing. We facilitated certainly some automation. We're still on that journey around increasing capacity, around reducing costs, around increasing the product range available. We also facilitated a large debt facility for the business, which I don't think they would have obtained without the equity backing that we were bringing. So that was pretty fundamental in funding a lot of the acquisitions and the growth that the business was going through. And then we helped really expand the executive team and devise the strategy ready to execute on the growth. So as you can see, I guess we offer a lot more than just capital. When we say we're an active investor, this is the kind of stuff that we're talking about, where we, with the founders, work with them to help execute on an agreed strategy, whatever that is. That could be international expansion, that could be geographic expansion, that could be vertical integration, addition of new facilities, for example, M&A, capital structure. Here's a good example with the debt facility, etc. So a lot of the founders we talk to may have expertise in one particular area, but not in others, obviously are lacking there. So we try and bring that obviously to the table, and to the extent we don't have it, then we'll find the right people to assist as well and make sure that we get there together. So I think that was all we're about to cover, right in the half hour. So I might open up to Tim to manage the Q&A.
Thanks, Patrick. And thanks everyone for listening to the formal presentation part of this session. Now we're going to turn to Q&A, so please feel free to raise your hand and I'll endeavour to look out for you and you can ask your question live, or if you'd prefer, please feel free to use the Teams chat to write your question. We'll do our best to endeavour to ask all the questions, but if we don't get to them, we'll make sure to send a written response post the session.